Are you looking to evaluate stocks just like Warren Buffett? Well, this is going to be a beginner's guide to learning the fundamentals of value investing. And in this video, I'm going to cover 6 metrics with you that Warren Buffett uses to evaluate value investing stocks. Now, these 6 metrics come from the book Warren Buffett and the Interpretation of Financial Statements. And what I'm going to do is assume that every viewer watching this video is starting off with zero knowledge on how to read financial statements. So if you find yourself at a more advanced level, please feel free to skip ahead, and I've added chapters to help with that. I've also linked in the description a cheat sheet that you can use to follow along as we're covering these concepts. So to start us off with some basic accounting, there are 3 financial statements that are in every single stock in business. And the first financial statement is the income statement. Now, it's important for us for each statement to have a basic, just rudimentary level to understanding what this statement does. So in the case of the income statement, what we're looking at here is how much did a company earn subtracted by how much that company spent. And this lets us know how much money the company had left over. If we can remember this, we will always understand the basics of an income statement. The next statement is our balance sheet. This is also known as a net worth statement. This lets us know how much assets do we own, subtracting how much liabilities that we owe, and this gives us our shareholder equity. This is also known as the balance sheet equation, where assets equals liability plus equity, or said another way, assets minus liability equals equity. And our final statement is the cash flow statement. This lets us know where all the money is going. Now, at the bottom, you'll see some subscript that says profit is an option, cash is a fact. And that's because you don't have to be profitable to still have money moving in and out your business. Maybe you have some negative years, but you had cash saved up on the books. So there's still cash movement, whether or not the company is profitable or not. So now that you have a basic understanding of the 3 financial statements, let's look at the metrics on how we can evaluate stocks like Warren Buffett. So what I've done here is pull the financials for Apple. Apple's a stock that Warren Buffett owns in his portfolio. And our first metric that Warren Buffett looks at is having a high gross margin. So what is a gross margin? Our gross margin is going to be how much money that we make after we pay for our supplies. And Warren Buffett wants to see this above 40%. Now, why does Warren Buffett want to see this above 40%? The reason is that there's a good chance that if you have high gross margins, you have some type of competitive advantage because you can charge more while it costs you less to make your goods. Think about if I was selling a black t-shirt. Well, there's a lot of different people that can make a black t-shirt. Therefore, at some point, the prices are going to lower and the margins are going to lower, and it's going to be a race to the bottom. This is not good from an investment standpoint. On the other hand, if I'm selling an item like a Ferrari, it may only cost me $100,000 to produce the Ferrari, but since I have a competitive advantage with the brand, I could charge maybe $1 million for the car and create that huge spread. So how we figure out our gross margins is we're going to look right here on our income statement. Let's underline that right here. And we're going to look at our total revenue line. Now, this is represented in thousands as we see here. So although this looks like 416 million, it's actually 416 billion. We always add 3 zeros to the end of it. And we see here that total revenue in 2025, Apple made $416 billion. So this is the total revenue from iPhone, subscription, cloud, everything. And then it costs them 220 billion to make this. So there's some type of cost associated with making the iPhone. I have to buy the chips, I have to buy the processor, all those costs. And this leaves us with a gross profit of $195 billion. So what we do to figure out this ratio is we're going to divide a 95 billion by our total revenue right here, 400 billion. And this gives us a gross margin of 46%. So this checks out on our first check. Now, something to keep in mind is that margins vary from year to year. So we also want to check the trends of the margin. Has it consistently been above 40%, or is this just a one-off year? So we can go and look at the history of the company and see if they have a durable competitive advantage in their field. Now, the second metric that Warren Buffett is looking at is he wants to see that interest payments are below 15%. And the reason for this is if you have a large amount of interest that you're paying, that means you have a large amount of debt in your company. So what Warren Buffett is looking for is he doesn't want a company that's only growing because they're taking on more debt. This can be signs of a capital intensive business. This is very problematic in real estate stocks, for example, because real estate carries a lot of debt in it. And the only way to grow the business is to continue to collect more and more debt. So what Warren Buffett is checking for is that if your interest payments are below 15%, there's a good chance that you're not taking a lot of debt to finance your business. Now, the next question is, with this 15%, what are we comparing it to? And we're going to be comparing it to our operating income on this line right here. So we have our gross profit. After we've bought all of our supplies and materials, we still have to pay employees. We still have to pay to keep the lights on in the store for Apple. So after all of those costs are subtracted, we end up with our operating income right here, which was $133 billion in 2025. Now for our interest expense, this is going to be under this line right here. We see this line item interest expense, but notice that all the years Apple has two dashes. There's no number here. So what does this mean? Well, this can mean a couple of things. One of the things it can mean is that the company has zero debt. Now, I'll tell you right now, and we'll see this on the balance sheet later, Apple definitely does have debt, and most companies that are large traded on the stock market will have debt. So is it just that they're not paying interest? No. There comes a situation for a lot of companies where their interest expense is negligible based on the amount of interest income that they have that evens it out. So let me give you an example. Let's say you had $100 in your savings account, and this $100 gave you a 4% interest rate, just keeping it in the savings. So at the end of the year, you would have $104, right? Now let's say you had some debt, and on this debt, you borrowed $100 and you only had to pay a 3% interest rate. So at the end of the year, you had to pay $3 in interest. Well, I earned $4 in interest, but I had to pay $3 in interest. So I end up with a positive $1 outcome. So in Apple's case, when it has the double dashes, it's meaning that the interest that they're earning versus the interest that they're paying evens out, and it's negligible. Therefore, they have no interest expense, which is below our 15%. So this is good. Now, what if we had this number at, let's say, 50 billion, for example? They were paying $50 billion in interest. Now, what we would do is we would take 50 billion and divide it by 133 billion. So this would fail our metric test because they're paying 37% in interest payments on only making $133 billion. And let's think about what this is telling us from a value investing perspective. If I had to pay $50 billion in interest payments, that means I'm carrying on a lot of debt. That's just the interest on the debt. That's not the total debt. And it would force me to always keep taking more and more debt on to increase this operating income number and the revenue number here. And that's not a good situation for us. So metric number 3 that Warren Buffett wants to see is net income above 20%. And this is also what we call the bottom line. So here at the bottom, we have our net income line. And net income is the money that the company keeps after everything is paid off. So we have our total revenue right here. This is the total amount of sales that we made. Then we had to buy the supplies and goods to make the iPhones, to make the computers. And then after that, we had our operating expenses. We had to research, we had to pay our employees, we had to open the stores and actually do this, things like shipping, supplies, boxes. This gave us our operating income. And after our operating income, we still have to pay things like our taxes. We still have other expenses that may not be directly tied to the business, but nonetheless, they still have to get paid. When we divide this out, this comes out to 26%. This is a check mark. So anything below 20%, according to Warren Buffett, this is not a good enough margin. Now, net income is very important to have high, because think about if your net income was only 5%. We call this a very low margin business. Well, one of the first things that comes to mind is, what if pricings of your cost of goods sold changes and your net income is already very low at 5%? We had this happen with a lot of companies when President Trump put in the tariffs. This was a really big deal for a lot of companies, because a lot of companies are getting their supplies, their cost of goods sold, from China. And if these costs increase, this lowers the bottom line. So what we want as investors is we want a large margin of safety, because we never know what's going to happen with these companies. We never know how pricing power changes. So the higher this number on the net income line, the better. This gives us more wiggle room for the actual money that the company is going to be keeping. Now, keep in mind that this bottom line net income number is all money that the shareholders own, because as a shareholder, you are a fractional owner of the company, and this is money that's going to be either reinvested into the company or distributed to you as an investor. Now we're going to shift over for our fourth metric to our balance sheet. Our fourth metric is going to be low long-term debt. But this is very subjective. How do we determine low long-term debt? Well, let's first take a quick review of our balance sheet here. So our balance sheet is always made up of our total assets, our total liabilities, and that gives us the equity, the ownership that the shareholders have. So right here, we have our long-term assets line, we have our current assets line, and then we have our total assets. Current assets are going to be short-term assets, things like cash, things easily being able to be sold, like the actual iPhones. Those are short-term assets because we can just take those to market and sell them. Our long-term assets are going to be things that are much more difficult to sell, things like a factory or a plant. If we move down here, we have same thing on the liability side, our current liabilities, and then we have our total liabilities, and then all the way at the bottom, we have our total equity and total liabilities and equity. So what we want to do for the long-term debt, we want this number to be low, and we want to compare the long-term debt to the total amount of assets that we have, and also we can compare it to the total amount of current assets that we have. So looking at our balance sheet, we see that our long-term debt right here on this line is $78 billion. We're going to write that number down right here, $78 billion of long-term debt. And then we're going to go back up here and look at how many assets do we have. And what we can do is get some ratios. Now, ideally, as a rule of thumb, what you really want to look for is, can the company theoretically, in an Armageddon event, pay off all of its debt in less than 4 years? Now, our fifth metric is going to be comparing debt to shareholder equity. Now, I'm going to give you an example so that it allows you to wrap your head around this to easily understand this concept of equity. So when you buy a house, let's say you bought a house for $500,000, and we'll put a house right here. This is the cost of the house. And you put up $50,000 as a down payment on that house. So when it's all said and done, you have a $450,000 mortgage, and you have $50,000 in the house. Now, let's say this house right here appreciates to $600,000 over the course of owning it. So $600,000 on the house value. And you still had $50,000 of the payment in it. So you've knocked that mortgage down to $450,000. So the remaining amount you owe on the mortgage is $450. Therefore, now instead of $50,000 worth of equity, you have $150,000 worth of equity, because if you sold the home, you could sell it for $600,000 and make $150,000. This same exact concept is the concept that we want to use with our stocks, understanding for the shareholders how much equity does the shareholder own in the company compared to how much liabilities and debt that they have. And the more equity you own, just like the more equity you would own in your house, the better off the shareholder is of the company. So let's look at how we find this in the financial statements. Well, right here, we have this line that says total equity. So our equity is equal to $73 billion. And what we want to do is we want to compare this number to the total liabilities amount. How much debt do we have compared to how much equity? So we see our total liabilities right here. Liabilities, $5 billion. Now, oftentimes when we're evaluating stocks, we want exact numbers and metrics like, hey, how much should the exact ratio be? Instead of using exact ratios, I want to challenge you to understand the concept enough so that you can think freely, because every company is going to have different metrics. What I like to do is use a peer comparable, because different companies are going to have different amount of debt and equity, and this ratio is going to change. So we can't necessarily compare Apple to a company like Walmart. They're going to have two completely different business structures, because Walmart is required to carry a lot of debt because they have a bunch of different stores all across the United States that are the big warehouses, compared to Apple that just has a few stores in malls. So we want to do a peer comparison, but as a rule of thumb, I like to see this ratio no more than about 5. If I own 20% equity in the company and the other 80% is in debt, that's a pretty healthy mix. If we are to divide 285 by 73, we end up getting a ratio of 3.9. So we're under our 5. So what this translates to is for every $1 of equity, you have $3.90 of debt. And as value investors, we want this number to remain in check. Our sixth and final metric is going to be return on equity. And we'll review what this concept of return on equity means. And we want this to be above 15%. Now, what return on equity is going to tell us is what is the actual return on the ownership that we have in the company. I'll break down an easy example so this concept sticks. Think about if you bought a house for $100,000, right? And to buy this house, we put up a $10,000 cash down payment that is our equity in the home. Now, let's say we turned around and rented that home out, and after all the expenses, the mortgage was paid, we ended up with $5,000 of income from this rental. This would give us a 50% return on equity. Because let's think about this for a second. I put up $10,000 of cash. This is my own money that I put up, and this is my equity. And in return for that cash that I put up, I got $5,000 back. This gave me a 50% return on the actual cash that I put up. So this is return on equity. And we want to translate this same exact concept to stocks that we own, because we need some type of return on the ownership that we have. So to find this out, we have a nice easy formula that we can look at. What we're going to do is we're going to divide our net income over our equity. Now remember, in the balance sheet, we're looking at the balance sheet here, our total equity line is right here listed. And so in the denominator, we would put this at $73 billion. And our net income is going to be found back on the income statement that we looked at earlier. So let's scroll up back to our income statement, and we see our net income right here is $112 billion. And this is going to go in the numerator portion. So $112 billion. Now this gives us a ratio of about 1.53 or 150 153%. Clearly, this is well above our 15% mark that we're looking at, which is why, again, Apple is such a big portion of Warren Buffett's portfolio. Because if shareholders own $73 billion worth of equity, and every single year on the bottom line, they're getting over 100% return on their equity. This is a phenomenal competitive advantage for the shareholders that they're receiving because Apple has such a competitive moat around their business. Now, I'm also going to give you guys a bonus because in the metrics, Warren Buffett doesn't include looking at the cash flow statement, but the cash flow statement is very important for us to understand where the money is actually going. Notice the first line of the cash flow statement is the net income. Now, this number can be positive or negative because a company can make or lose money on the bottom line. And I want you to think about this from a personal standpoint. This always helps me simplify this concept to understanding and evaluating stocks. Let's say that you made a $100,000 salary. And after all of your bills, expenses, everything you pay for the year, that was $90,000 in expenses. You were left with $10,000 in money that you saved. Now, with this $10,000 of savings, this would be the equivalent of your net income, what was left on the bottom line. Now, you have a couple of choices that you can do with this $10,000. You could, of course, save it and just put it in your savings account. You could invest it. You can take that $10,000 and put it into the stock market so that you can grow your money. You can also have expenditures where you take that $10,000 and maybe you buy a new dining room set. Maybe you buy a new home with the $10,000 and you have an expenditure. So companies are faced with the same choices. What companies can do with the money that they have left over in net income on the bottom line, they have to make a decision on what's best. And this is what the cash flow statement tells us and lets us know. So when we look at the cash flow statement, we have this line right here that's called cash flows from investing activities. Cash flows from investing activities let us know where the money is going. And the biggest thing that we're looking for as stock investors is that companies are being good stewards of the money. So not many of you may have known this, but we have the Amazon Fire TV, but Amazon also had the Fire phone. And if you think about capital expenditures and money that's over, Amazon had to go out, develop a phone, pay for all the supplies, and figure out that this idea just wasn't a good idea. So sometimes companies go out and they make these projects and they're really big hits like the Fire TV, or they're really big duds like the Fire phone. But in the end, the money that the company is using to figure out all these experiences are money that is coming out of your pocket as the shareholder. So we can see this on this line right here of what is the company spending the money on. Right here, we have our capital expenditures. This would be doing something like building a factory or buying a new piece of machinery. That is a capital expense that they're putting into the company. Now notice that the investments line is positive and the capital expenditure line is negative. Let's go back to our salary example to understand this concept for a company. When you invest in the stock market, let's say we took our $10,000 and we opened up our Robinhood app and we invested into the stock market. Although that $10,000 is no longer in our checking or savings account, all we did was take it and invest it on Robinhood. But we still have the money. It's still an investment. Now that investment can go up or down, but that $10,000 for this moment, when we put it in Robinhood to invest, it's still $10,000 that we have, which is why this number is positive. This is unlike if we were to go out and make an expenditure like buying a mattress. Maybe we buy a mattress because mattresses help us sleep better, and that could improve our performance and how we are able to operate at work. This would be a capital expenditure, but the money is still gone because the minute we buy this mattress, we can no longer go to the market and sell it for a higher price. It immediately is depreciated and is worth less. Same concept for companies right here. And then this leaves us our net cash flows from operating activities, right? So the cash flow statement just gives us a snapshot on what are the things that the company is actually spending the money on. And we want to make sure that they're being good stewards over the money that Otherwise, it could be paid out to investors in dividends. So now that you have a clearer understanding on the 6 metrics that Warren Buffett uses to evaluate stocks, this is going to allow you to screen for potential investments much faster. Now that you know the fundamentals of reading financial statements and evaluating stocks for value investing potential, what I want you to do is download the free cheat sheet that's going to help you out doing this process over and over again. And then check out my next video where I discuss how I learned to invest correctly before it was too late.